Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. We have with us Vatsal Shah and Poonam Rungta. Vatsal, Poonam, thanks so much for joining us. Let's go straight to the first caller. Ashok Sharma is on the line from Ludhiana. Good afternoon, Ashok ji. What's your query?
Good afternoon, sir. I'm Ashok Sharma from Ludhiana. I put my query to you.
Yeah.
Since I watched your program 1 month back, I have invested in mutual fund from last 5 years and have a corpus of around 85 lakhs.
Okay.
And now I'm going to retire after 2 years. So my query is whether I should remain in this funds or shall I shift to a safer balance fund where I can withdraw through SWP for my routine expenses.
Right.
The funds details is Aditya Birla Sun Life.
Okay.
I'm still doing SIP in that.
Okay.
ICICI Focus Blue Chip, IDFC Premier Equity, now it is multi-cap. Axis Long Term for ELSS.
Okay.
And there are other Canara, Robeco, Mira Emerging. So total, including all, I'm doing SIP of around 55,000 per month.
Okay.
I'll do it another 2 years. And the corpus, I expect it should reach around 1 crore. And later on, what I should do? Shall I shift to balance? I'm having one balance fund also, SDFC balance, that is around 13.5 the value, and SIP is 4,000 per month.
Okay. Vijay, would you want to answer that?
Yeah. Hi, Ashok. Good set of funds and a good selection of investments. My only point to you would be that if you have a risk appetite and if you are comfortable holding equity, then continue to hold. A traditional thinking would say that, after you retire, move it to balance funds.
Right.
But I think he would have, if he has risk appetite, then he can continue to hold because next 5 years or 10 years looks very good for the equity market.
Correct.
And since he's been holding for a long time, he would be in a reasonable profit. So keeping that in mind, he can continue to hold. That's what I feel, and take an SWP out of those funds if he's in significant profit. So there is no harm in actually taking money out from my equity fund.
But the mix of the funds are good?
The mix of funds are good because it's a large cap oriented and a multi cap oriented. So no small cap, mid cap kind of a thing. So that way the mix of funds are also good.
Okay. Mr. Ashok Sharma, very clearly you've got a good mix of funds, and since the equity markets over a longer period is going to be good, I don't think there is any reason to switch, and you will earn better returns, and systematic withdrawal plan is going to help meet your requirements. Go ahead. All the best with your investments. The next query is from Delhi. R. Shekhar has sent us this mail. He's 32 years and he's planning to retire at the age of 45. Okay, he is currently investing through SIP in Tata India Tax Savings, Mirae Asset Emerging Blue Chip, DSP BlackRock Tax, and Kotak Standard Multi-Cap Fund. He wants to know what the outlook is. He's 32, he wants to retire at 45, and he has got these goals.
Yeah, selection of funds are good, like he's included a multi-cap and Mirae Asset Emerging, which are good top rated funds, and also he's doing tax savings. So I presume that ATC 1,50,000 he is absorbing in ELSS, which is also a good way of building a good wealth, because usually people in ATC blindly park money in a PPF and conservative products. Over a period of time he will understand that it is, and he's retiring at earlier than the retirement age. So I'm sure that even if his goals do not meet at 45, he can prolong it further. So I'm happy with the way he is investing, and it's a good diversification also. Continue with the same.
Okay, continue with your investments. Good diversification, good selection of portfolio of funds. The next query is from Gujarat. Suresh Lalchet has sent this mail. He is asking for details about mutual funds. He is very new to the field and does not know how to invest money in the mutual funds. He is also asking for an advisable time horizon and minimum amount of quantum for investment.
So very valid, and this question would be relating to many people in India. So investing in mutual funds is very easy. You just need to do your KYC once, so you can catch hold of any good distributor in your area, or there are many online distributors as well. But I would suggest, since he's new, he should meet a personal distributor in person and then do his KYC. After doing his KYC, he can open a mutual fund investment account and he can start the investment. Coming to how much to start with, he can go as low as 100 or even 500 in some schemes. But what I would suggest is look at the India average. India average is 3,300 per month. So at least 3,000 he should invest in the mutual fund through an SIP to match up the average of India SIP rate. And then from there on increase on a year-on-year basis. Time horizon minimum 5 years.
Minimum.
Don't expect any return for 5 years. He'll be happy.
Absolutely.
Since he's new and he's starting, I'm sure you'll agree that he should first look at his goals and set a proper planning.
Very clear.
Investment should be done in a planned manner. It's a process. It's not a one-time thing to randomly do it and then sit and review it every 2 months.
It's not an FD,
It has to be done very consciously after proper planning. So I would say, since you're new, you haven't started in mutual fund, meet a proper professional, set your goals and then start. That will be a better approach, and a professional will be able to help you define your time horizon.
Okay, have a disciplined and clear approach to what and where you are investing over a certain period of time. Let's go to Chennai. We have Devarajan on the line. Devarajan, good afternoon. How are you?
Fine, sir.
Yeah. Tell me, Devarajan, what's your query?
I am a senior citizen. I am running 65 now.
Right.
Already I have invested in HDFC Top 100 and Reliance Pharma Fund.
Okay.
I am holding some equity also. I have lost heavily for the last 15-20 years. Now I am working. I am earning 20,000 rupees per month.
Okay.
Out of that, I want to invest 10,000 rupees per month for my grandson and granddaughter.
Okay.
I have no time horizon. I am not going to take the money. So, which fund that can take care of any fluctuation in the market, whatever it is?
Right.
For 10,000 rupees per month, which fund I can invest?
Okay.
For the future, I will be much grateful and thankful to you if you suggest me, sir.
Okay, so Devarajan's requirement is very clear. He does not, they should not be too volatile. There should be steady returns over a period of time. Vatsal, what's your recommendation?
See, I also feel the existing balance is very odd mix. He has a tax saver and a sectoral fund. So he should actually look at, he has a large cap and a sectoral fund. So I would suggest that your mix should be a large, mid, multi-cap. Sectoral fund is like that dessert in a food plate, so you can't have roti and dessert. You need the dal, chawal, sabzi also. Right. So you should have a good mix there. For your grandchildren, I would definitely recommend go for a children's gift plan like a HDFC children's gift or a Axis children's gift. The reason is it is not as volatile. It's more of a balanced kind of a fund. And I understand that he doesn't have time to probably just analyze the returns all the time. So he can actually just invest and easily gift it to his children when they come to a particular age.
Right. From Chennai, let's go to Bengaluru. Swami is on the line from Bangalore. Good afternoon. What's your query, Swami?
Hi, good afternoon. So my query is, my father has just recently retired, and we have a fee around 50 lakhs that needs to be invested. This is his retirement corpus. So my query is, what should be the ideal allocation between debt and some pieces of equity, because he just recently retired. So we are most probably looking for a wealth creation over the next 15 to 20 years down the line. And again, within the debt side, should I, since the interest rates have been moving again towards the upside, should we be looking more on the liquid side, or how the long term or the gilt funds would actually would be a preferred choice?
Right. Okay. So you don't need to withdraw cash in between. You can stay invested for long time, right?
Yes. so he already has a pension on which he can sustain. So this particular cash is purely only for wealth creation.
Absolutely pure, very clear goal and objective. Yes. Poonam, would you want to advise him?
So with what Mr. Swami just said, I feel that his father is looking at leaving a legacy kind of a thing, create a wealth for his legacy, or maybe use his extra money for any emergencies which may come in later in life. So you can have a mix. I mean, I wouldn't usually at retirement age I feel balanced fund or little conservative.
Yeah, but in this case
this case this is not required. But still, it's a retirement money. You don't want to play with your capital too much. But time horizon is long. Good. There is no defined time horizon. So what I feel, you can take a mix of a pure debt fund and a pure equity fund, a mix of both, because Swami also has this little knowledge about the interest rates thing. So you can choose an accrual fund, you can choose an HDFC accrual fund or a credit risk fund, which is a pure debt. We are very positive on that. We are even recommending our clients on the debt side, and a pure blue chip fund like a SBI blue chip or Aditya Birla frontline equity fund, because equities again in next 10 years we have a healthy India story coming up. So a mix of both can give you a balanced approach, and you can make a good wealth.
Swami, hope we have addressed your query. Do you have any follow-up?
Yeah, if you can just recommend anything very specific on the debt funds. I think on the equity side you did recommend. If you can just couple of them.
You can go for HDFC income fund.
Okay. HDFC income fund is what our experts are recommending. All the best with your investments, and let's move to Delhi. Thomas has sent us this mail. He is investing in Tata India Tax Savings and Axis Long Term Equity Fund. He wants to know if he should invest through SIP for a long term in both the funds, or should he switch? He is looking for wealth creation over a longer period. Vatsal?
Yeah, so since the period of investment, Thomas, is long, wealth creation comes from a little risky bets as well. So I would suggest that your existing schemes are fine, but you should also look at adding a mid and a small cap. So particularly HDFC mid cap and Reliance small cap, both are good, well-performing, good
over a longer period.
Though again, word of caution is that maybe next 2 years will not see any return in that, but the third, fourth year will cover up for any of the non-performances.
And going through SIP route is the best option.
Is the best option. And again, since wealth creation is the only goal, he should, just one word here is, he should know how much wealth he wants to create, and then backward calculate the SIP amount,
and then plan accordingly and invest.
Just general wealth creation is a very generic term, and maybe he will fall short if he really has something in mind. So he has to have that figure in mind.
Absolutely. So you should have a very clear figure of how much you need, let's say 10 years down the line or 15 years down the line, and calculate backwards and accordingly allocate. And then that should help you, since it's a long-term investment. The next question is from Pune, Murlidhar Karyakarte. He is asking about MF schemes with dividend payout option. He wants to know how should one calculate the CAGR, compounded annual growth rate, when these schemes show appreciation even after dividend payout.
So usually when the dividend is paid out, the portion of dividend paid out is actually the profit made by the scheme. So the NAV falls down in proportion to that, but at the end of the year sometimes the NAV is higher also if the fund is performing very well. So when you are calculating CAGR, you have to take in consideration the dividend received as well as the appreciation both, and together you can understand how much profit you've made, because ultimately whatever dividend we receive, we may again reinvest it. So even that you can take in consideration. The IRR will include all of that. So you must take into account both.
Okay. With that, it's a wrap on this edition of the Mutual Fund Guide. News and updates continue on the other side of a very short break. Stay tuned to BTVI.